Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. I've got a legendary guest this week, Owen Raszkiewickz from Rask. Owen, welcome, and how did I go with the surname?
Fantastic, mate. You nailed it. So we're just talking off air. I don't know about legendary, but I'll take it. If people want to Google it, don't be ashamed if you get it wrong. Pete and I just went over it a few times. Great pronunciation, mate.
Owen R. Just Google Owen R. and you'll get somewhere close. So,
yep.
All right. Well, let's start from the beginning, shall we? Now, I went to a Catholic school when I was growing up, which was 50% Irish, 50% Polish, more or less. So I'm guessing that Raszkiewickz is a Polish name. So am I right in thinking that your grandparents left Europe for Australia? Is that right?
That's right. Yeah, mate. Exactly. So my grandparents were survivors of the Holocaust. They were in Dachau concentration camp, and that was on my mum's side. And on my dad's side, they were English, from Kent. Both ended up in Australia. Took the boat ride through to Australia. My grandma and grandpa actually had the choice of Brazil, Australia, and I think the other one was Portugal. So I'm very fortunate they chose Australia because I got to speak English, and here I am. And yeah, basically that kind of informed our worldview. I'm sure we'll come on to finances in a minute, but that kind of heritage, one side being English, the other side being Polish, and a survivor of a very difficult stage in the world and time for the world, informed basically what come next when they migrated to Australia.
Yes, I had no idea about the Anglo side of your family. I actually recently watched a documentary on Dachau. It's quite unbelievable at a distance of decades to sort of just to find out some of those stories. Unbelievable, really, and a warning from history, I suppose. And interesting thing, actually, that we've got a place in England that we spent some time at, and there's a town nearby called Boston, and this is a new wave of Polish migrants to United Kingdom. And you see the migrants go there where the couples both work and they buy a cheap house and a car and have kids, and now they're sort of second generation and soon third generation. It's beautiful to see that, and it's, I guess, what the capitalism is all about: people making a better life for themselves and their families. Ironically, a lot of them are moving back to Poland now because of the boom in Poland. So was there something of a migrant mentality in your family? I've noticed, sometimes with new migrants, they tend to be a sort of a frugal mentality because you've come from such a tough background and even just one generation back, an unbelievably tough background.
Yeah, we spoke on our podcast, on the Rask podcast, about kind of like the personality types. And my parents, so not necessarily my grandparents, they were very frugal, both sides. But when my dad's side of the family that came from England, they landed in Fremantle and lived in those kind of long, kind of, I don't know what you call them, but like the half circle kind of communal housing. And they stayed in those for many months, and my grandpa was a carpenter. So he actually started working on those kind of hut-looking things. And from the other side, from the Polish background, my grandma came to Australia with my grandpa, and he died when my mum was 10. And so basically left my grandma, who didn't speak English, fending for everyone. She had 4 or 5 kids. And so the worldview, and then how that translated into their, I guess, attitudes and personality types, at least with respect to money, was pragmatists. So it was not necessarily optimistic. It wasn't creative. It wasn't any of those things that you might associate with younger people these days that have, stable upbringings. It was more so, how do we kind of make ends meet? And we work harder to make money. So we don't invest. We don't do anything like that. We save money. we save as much as we can, and we kind of deny ourselves because we've got to work hard for every dollar that we bring in. And so that trickled down to me and my generation. And so my dad was a painter, and my mum worked in disability services. So kind of more like, I guess, lower skilled jobs at first. And so then when it pushed down to me, that's kind of what I knew. The virtues were hard work. I think I was only the second person in my family lineage to go to university. And I ended up studying more and more and more because that was kind of what was instilled in me. Like, you work hard. If you're going to study, you do it properly, and you do a lot of it, basically. And so I did that, and that kind of carried through, like the insecurities around money, the insecurities around investing, lack of trust in the system. I remember when I was younger, even something so simple as filling out a tax file form, I thought something's going to go wrong here. Something is not right. Like, this is not going to work, basically, because that's the value set that I had was, don't trust the system. Don't trust anyone. Fend for yourself. And so I was very insecure about money, which is ironic because then I ended up working in finance. So here I am.
Yeah, I've heard you say before about a challenging upbringing and maybe a difficult sort of relationship with money. And as you said, almost like the system is kind of against us because you're not from the right side of the track, so to speak, or in financial terms. Now, my parents divorced, but they didn't separate till I was 18. So I was kind of flying the nest and going off, and I was a bit of a rebel, but off to do the higher education thing. I've heard you say like you had some sort of wild child years, but then you sort of turned it around when you were a teenager after some difficult years. I think in my case, I know that my dad would have basically just killed me if I misbehaved too much. So it was easy for me. But how did you go about turning it around in the first place, let alone then going into a high-flying career in, now as running your own business? But how did you actually go about turning it around? Was that a conscious decision?
Yeah. So my parents divorced, and it was, I can say this, it was quite a messy divorce, and basically resulted in one of my parents slipping into depression for probably 10 years. And so they divorced when I was about 13, which is kind of a formative year. So then I acted out for a very long time. I actually have people message me on Twitter, on Instagram, or send me an email that went to school with me. And they say, I cannot believe that you ended up, on the telly, talking about finance, talking about investing, giving advice to people. Like that's how I was perceived. And that was fair enough because I was without structure and I was without all of those kind of stability that you would associate with someone who then goes on to pursue a white collar career. That was really formative for me in a few different ways. One, I acted out a lot earlier than what probably most people do. So maybe instead of going out drinking, doing all these types of things at 18, I was doing them at 13 or 14. So I experienced that really early in life, and I experienced the kind of harsh realities of that really early in life. And then so when I got to say 15 or 16 and I could work, those pragmatist values came back, and I really had to I felt like at least I had to fend for myself. So, through high school, I would work 5 shifts a week. While going through high school, I would really just spend every waking moment trying to be effective. And I have this joke, which comes from Brooklyn Nine-Nine, that basically my value set now is efficiency, efficiency, efficiency. And the joke is on Brooklyn Nine-Nine that you can only say it once and you have the same effect. So that's basically how I've lived my life since then. And the way I turned it around was I basically got to a point where I was thinking to myself, I can either pursue a career and try and make something of myself, so to speak, air quotes, make something of myself, or I could just kind of continue on my path and, kind of just forget about that and distance myself from the responsibility of life. And I thought, no, you know what? I'm going to give it a crack. I'm going to do what I can at school. I'm going to do what I can in my career. And I have this kind of this other personality type, which is more the creative personality type. So even though my parents might have been pragmatists, I was more the creative. And with the creative personality type, typically what you do is you take risks. You're more optimistic, more like giddy optimism sometimes. And you want to build things. You want to create things. And so that's basically where the business manifested itself. And that's the origin story, which I'm happy to get to as well.
Yeah, so tell us a bit about how you got into finance and investing and being the guru on TV, telling everyone to have discipline and patience, things that you might not have had when you were 12 or 13. So I remember you from Motley Fool days, and then I was a fanboy of Rask from the early days. So what was your first investment, and how did you even get the bug, so to speak?
So when I was younger, because we grew up on a farm, we grew up out towards the Yarra Valley in Victoria. I was very blessed that my parents bought that house. They bought it for $150,000 with about $120,000 on the mortgage, and it was a 10-acre property. There were squatters living in at the time. There were so many blackberries on the property that we didn't actually know that there was a shed on the property. That's how overgrown this place was. But we turned it into something, and that's kind of where I learned the value of hard work. And we also, it turns out, we figured out that there were bulbs and things like proteas and waratahs growing on the property from the farmers that had it before us. And so I would take those things, I would cut those flowers, and I would go and sell them in a tourist area just up the road. And so I had this kind of entrepreneurial side of me where I wanted to make money, cash money. It got to a point where the council, actually, I was reported by the shopkeepers because I was taking their business away from them. So every weekend I would go up and sell these plants and these flowers. And it kind of dawned on me that you can make money by starting something. Like, you can create something that creates value. And so that's where the entrepreneurial thing kind of traces back to. But the actual way that I started investing was through a friend. So my friend was studying nursing, and he saved about $2,000 or $3,000. I was studying engineering and science at the time, and he happened across this email from this company called the Motley Fool, and it talked about investing. They just started in Australia. This was 2013, 2014, probably a little bit early, maybe 2012, 2013. And we both started looking through the financial paper after reading the Motley Fool free newsletters. We went to a page in the AFR which listed all the stock prices. And basically he said to me, "Hey, let's make a decision. Let's try and invest in one of these things." I said, "Okay, cool, let's do it." And he closed his eyes and he pointed to the page, and there was a company there. And I said, "Oh, no, we can't go with that one. It didn't go up by enough yesterday." So I found the one nearest to his finger that went up 10% the day before. And it turns out it was this little speculative miner in Indonesia. And he bought the shares. Fortunately, he didn't lose that much money, but it wasn't a great investment. But that was kind of enough to figure out how to just throw ourselves into it, to just take a punt. It was kind of from that mentality. Then we basically thought, okay, this is interesting. We don't know what we're doing, but it's interesting. He's starting to be a nurse. I'm starting to be an engineer. Let's figure out how it works. And from there, we started reading more. We eventually, over one summer, did a diploma of financial services because it was free at the time, because the government had subsidies if you were upskilling. And because we hadn't completed university, we were upskilling. So we did that, and that taught us about financial planning. And I started to invest. My first investment was NAB, the bank. Bought some shares, probably $1,000 worth. And the reason why I bought NAB was because I opened my CMC Market stockbroking account at the time, and I looked around. I'm like, okay, what can I buy? And at this time, international trading wasn't a big thing. So I looked around. I'm like, okay, Apple. Typed it in, didn't work. Okay, what about Microsoft? I'm using a Microsoft computer. Didn't work. I'm like, what can I actually invest in? And I thought about all the names that I know. And then NAB was the first one that came to mind. I thought, that's Australian. Surely I can buy that here. And I did. So that's why I bought NAB. And I was just very fortuitous from that point on, or very fortunate, I should say, because interest rates started to fall. We moved into a bull market, and my curiosity just took off from there.
You've basically gone, just to recap there, from buying the shares that went up most yesterday, which is kind of a momentum type of approach. Past performance may not equate to future results, to a bit more of almost a Peter Lynch style approach there, buy what you know, of National Australia Bank. And then, so where did you go to from there?
Well, the thing is that, as you know, those aren't necessarily the be-all and end-all in investment strategies. So
it was maybe somewhat tongue-in-cheek.
So it basically went from there, okay, let's find out what's behind the ticker code, the stock symbol. Let's actually find out what these things do. Let's find out how they operate, how to read financial statements, and so on and so forth. And I basically went on this 5-year journey of studying, so the academic side of things, but then also learning. I was fortunate that the Motley Fool sent out an email and it said, we're looking for freelance writers. So if you go to their website today, they have a lot of like market reporters and writers that contribute to their website. At the time, there was only 2 or 3 of us. What we did was we weren't sure, my friend and I, we weren't sure if the Motley Fool was looking for more than one writer. So what we did was we wrote the articles both under his name, just so we could proof each other's work, make sure it was good, and then also make sure we got experience from this. And then it came, the cat was out of the bag about a month or so in. We said, actually, there's 2 of us writing here. Can we both start writing for the website? And so I started writing under my own name. And then it went from there. Like we discovered some fantastic investors that came through the Motley Fool, people like Scott Phillips, who most people know here in Australia, but even people from the United States like Morgan Housel, David Gardner, Joe Mager came out to Australia, Matt Joss, who now runs Maven Funds Management, like all of these people, Andrew Page, who founded Strawman, Claude Walker from A Rich Life, like all these fantastic analysts came out of this time in the Motley Fool when we were there. So it was a huge opportunity for osmosis to kick in and for me to learn just by seeing what other people are doing. It also just happened to be the case that for the 2 years that basically I was most involved with the Motley Fool, they were also voted the #1 place to work for in the world for companies under 500 people. So they say that the first job that you have out of school is the most influential and profound on your career. And it has to be the case. I have to pay a lot of, credence, and I owe a lot of goodwill to the Motley Fool. And basically from there, my journey began, okay, well, let's find out what other people have done before me. So what fantastic investors have gone before me and how do I learn from them? So books, textbooks, podcasts. I even, read your books. Everything like that was just, it was gold to me. And I just consumed it like it was water every day, just couldn't get enough of it.
Yeah, that's amazing, actually. I know Scott Phillips, I bump into him at the News Corp and Sky News studios occasionally, but all of those different guys, contemporaries of yours. And I guess just something that occurs to me there is how they've all sort of forged their own investing style over time. Joe has his sophisticated screening, and I guess Morgan Housel would be more of a sort of passive or index type of investor, and Claude likes growth stocks and deep analysis. And I guess what, it's a journey for everybody, is to find what is the method or the investment style that works best for you. And I guess the great thing for you, Rask, is that you've done that in tandem. So you followed your passion of investing, but also built the business alongside it. And I guess, you've enjoyed, I guess, that thing where, if you can make your passion also your, or make your vacation your vocation, then it feels like it's not work to a certain degree. Is that how it's played out at Rask?
Yeah, it has. And it's much the same as, I would say, Dessa, your journey. You figured out what worked for you, and it might have been, it's your own path, right? And you went about it in your way. You bought different stocks, and your investing evolved, which was spoken about before. And so did mine. There's this thing, there's this idea, this concept called a humility curve. And it basically tracks, and for those of you that aren't watching, think of it like it's like a parabola. It goes up and then it comes back down the same way. What it is it shows the complexity of your investing over time. So it starts off really simple, like I was buying NAB shares, and then over time, you get more complex. And you might say, okay, I'm going to buy some speculative miners. And then you think, okay, now I'm going to buy some leveraged product that I don't really understand. And then all of a sudden you start to lose money, and you come back down the other side, down this curve, and it gets simpler and simpler. You're investing over time. And this is the kind of journey that everyone goes on. And I found that over time, like investing in what you know makes sense. Investing with things that you can control, so things like low cost funds or ETFs, all of those things start to play to your advantage if they are within your circle of competence. And for me, they were. Another thing that I realized is that when I looked around me at the people that I knew, family, friends, acquaintances, what have you, I realized that most of the people that were wealthy, and I mean wealthy in the financial sense, they started businesses or they owned businesses. So not necessarily did they just invest in public markets like shares or index funds or whatever, but they may have also started their own business or run their own business, if not forever, maybe for a period of time. So I thought, I understand what it takes, and I know it's a big risk, but if I was going to do this, now would be the time to do it, because I'm fresh out of uni. I've got a little bit of money behind me. I've got low costs. I don't have kids, don't have a mortgage. I'll give it a crack. Something that I love doing. And so I basically took all of the money that I had, instead of buying a house or doing something like that, I basically put all of that into this business, this startup. And the idea of, I think Scott Pape calls it a trapeze. You don't want to let go of one until you grab the other one, kind of thing. Or Warren Buffett says, don't test the water with both feet. I definitely took a leaf out of that book, and I started the business on a part-time fashion. So I was still contracting for half of my day, and then the other half of my day for 6 months, I would work on my business. And at first it was education. So purely creating educational videos or, websites and things like that to help people invest and to help people learn about money. I didn't do this on purpose, but it's kind of like cashing in on the Feynman technique, the physicist Richard Feynman, who talks about basically the way to learn something is to explain it to someone else, identify the gaps, and then explain it again until you're happy with it, and then simplify that. And that's basically what I did through the building Rask. Today we serve some months closer to 100,000 listeners on the podcasts. We have 16,000 students enrolled in our online courses, 100,000 plus readers of our news websites. We have thousands of members, and it sounds fantastic. It took a long time to get here, but every day I get to wake up, talk about investing, build things that help other people invest, and then it helps me invest along the way. So Vocation, Vacation, absolutely, mate. I mean, I'm not quite living in Noosa yet, but I'm
working on it.
Working on it, yeah.
Next
so
year.
That's how it all come together.
That's interesting. The Feynman technique you mentioned there. Certainly something I've noticed is if you write blogs or books or whatever, then people ask you questions, and they ask about things that you might not have then thought about. And then that becomes an educational piece for yourself. So it's kind of reflective, and you're always learning as a result. So it's a really interesting insight. Now, I'm going to come on shortly to some of your stock market investing strategies. But being a property pod, I know you bought a place of residence. And I know you said just before there, starting a business, it can be really hard for people in the corporate world, because you've started to build up all these expenses, then you've got a mortgage, then sometimes kids, and you've got all these like outgoings and then people think, oh shit, well, it's impossible now to start my own business because I've got all these commitments. And as you said, there's different ways to transition. As you said, you were still contracting, you didn't have a big mortgage around your sort of noose around your neck. I went through a similar process, but I was a bit older. I was 33, but I think I've said in another podcast somewhere, one of my uni housemates just quit his degree and started a business straight away. So it's a different journey for different people. Now, as a small business or startup business owner, you obviously don't have years and years worth of tax returns, and you, to some degree, you're trying to minimize your profit sometimes so you don't pay too much tax. So you've got through the process of buying your first house. Getting a loan as a business owner is not always easy. Then there was COVID. I remember Combank were calling for a 30% crash. So, and I've heard elsewhere you said that you went through the process and you've done some renovation and added some value with a deck and so on. So tell us a bit about what you did and why, and what comes next.
We didn't have as much money saved up as we wanted. We didn't want to sell all of our shares and all of this sort of stuff. And because our business had gone through some really tumultuous events over the past 24 months leading up to it, what we found was that the business effectively didn't have profitability for 12 or 24 months when we were going through the home loan application process. So they couldn't actually take my income into account. So we used something called a common debt reduction loan scheme. So basically what that means is that my wife became the owner of the property and got the mortgage in her name, but my income and expenses wouldn't necessarily deduct from her borrowing capacity. And so that was actually was worked out better for us anyway, because we wanted some separation, some legal separation between our property and our business, just in case one of them fell over. And the way we went about it is we actually bought a home. We heard it was coming onto the market. It was off market and it was coming onto the market on the Saturday. And we knew about it on the Thursday afternoon. So what we did is we organized with the real estate agent to go and inspect it on the Friday morning and have a look at it, because this was a really hot property market at the kind of like at the beginning of COVID, in my area out at Eastern Melbourne. What was happening is one property that we went to, for example, had 120 people through in half an hour, 120 groups. So it might be a couple or an individual. And so the demand was absolutely skyrocketing. But we were very fortunate that on the Saturday was the day, or the Sunday was the day when stage 4 lockdowns were coming in Melbourne. So you couldn't travel more than, say, 5 or 10 kilometres. So all of a sudden that knocked out everyone that was coming out of the city to buy in our area. It's about an hour outside of Melbourne. And so we inspected it the Friday morning, I believe it was. And before that afternoon, we had our offer on the table. And we made that offer very short in terms of we gave a really good price first up, but we said it's going to expire. I think it was in like 1 or 2 days, knowing that we're going into stage 4 lockdown. So the basic idea was hopefully we didn't get as much competition, and hopefully we could put in a really good offer, a really fair offer to the owner at the time to say, take this now before lockdowns really kick off. And that worked for us. And we got the property that we wanted. We bought a property that was on a main street. Like when I say a main street, I'm not necessarily like a busy freeway or anything like that. It's on a good road, sealed road in our area. We live in the Dandenong Ranges, so out in the hills. It was one of the most sought after streets in the neighborhood. It's on flat land, which in the hills is quite rare. The house is not very like glamorous. It's probably one of the worst house and best street type thing. But because I spent some time when I was through uni working with carpenters and electricians, I kind of knew my way around a tool shop, so to speak. And so I could add value to it without paying through the roof for tradies or whatever. So yeah, here we are. We've got a property, and it's been a fantastic purchase because it's an investment grade property, and it's a asset that we plan to hold for as long as possible. I think one of the things that you impressed upon me, Pete, when we first spoke, is that with good assets, the ideal holding period is typically forever. Like you can hold on to good assets because they keep creating wealth for you. So that's what we intend on doing.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyers agents, we can lock in highly competitive prices. Plus, our national network of buyers agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
Some people who absolutely love the stock market, well, they'd say, well, why would I tie up some of my money in a home? But it's not purely a financial decision, I guess. It's also a lifestyle decision. And yes, you can add value to some properties, but actually at other times you've got the council in your ear or neighbours complaining or body corporates that say you can't, or you might not have the time or inclination. This is a big debate, the benefits of buying your first home and investing outside of that, or rent vesting. Are there any sort of consequences of not buying a property? Because I guess the obvious potential benefit of property ownership is that you've got this kind of unique triumvirate of lending conditions. You've got low rates, low interest rates. You get a very high loan to value ratio and very long term, so you can borrow for 30 years, no margin calls. And you can potentially then refinance and invest in stocks or another property or something else down the track. So what do you think about the benefits or the pros and cons of home ownership? Because I guess that for a lot of people, the model is you buy your home, you do your super, and maybe stick some money in ETFs outside of that. But what's your view?
Yeah, I think you summed it up neatly there in that last part where you said, yeah, for most people, it's a pretty simple formula, right? Like I studied financial planning. I work in an office of financial planners, and our business is basically set up to help people get the most out of finances and whichever way they want to take that, to be honest. And it's like, I was thinking about this in anticipation for today's call, it's basically, there's a continuum. It's not necessarily like there's one right way for everyone. Some people might be at one end of the spectrum where they want a completely hands-off way to create wealth. And at the other end, people want to be really active and they want to pick individual shares and they want to try their hand at crypto and they want to do this and do that and try this and try that. And that's fine too. It's really about understanding who you are and what works for you. for me, what I see is like the middle of the bell curve, what most people would do, and what most people probably should do, to be honest, is they want to buy a home, a good property, because one, it's going to be a major part of their wealth, whether they probably like it or not. It's more of it can be a lifestyle asset and a way to create wealth. Like you said, there's leverage around it, and it's low cost leverage because of the nature of the asset. And because of the nature of our regulatory environment, you can get lower interest on a property than you can on an equity portfolio or a share portfolio. And also, shares are more volatile. The prices bounce up and down, and that's reflective of the risk you take in taking a loan out to buy them. So the final thing on that is that there is a lot of utility in owning a home. So when I say utility, what I mean is you can do more with it than you can necessarily with a share portfolio. So a good example of this is, as you just alluded to, is you can buy a home. You can do some things to it if you want to do things that are within the council regulations and, all that sort of stuff. And it may add value to the property. You can use an offset account to, reduce the interest expense while also having that emergency cash buffer if you so need it. Another thing that you can do is, once there's enough equity, you can refinance. And this is, as you know, it's the process of basically drawing down on the existing property, using that money to increase the value of your property by reinvesting back into the home, or maybe it's buying another property, or maybe it's investing in a share portfolio. So one thing you can do is you can effectively have a line of credit that allows you to invest in another asset class. So you might say the property is my security and I'm going to invest somewhere else. And so I think for most people, the primary residence and using property as a vehicle for not only the property asset class is profound. And beyond that, it's pretty obvious that there are tax advantages to having money put into super. So I think where a lot of people miss the trick is they don't put money into super because they think, it's not really an investment. I can't touch it for many years. But if you're not getting PAYG and you're not getting that 10% put into your super, you should probably consider that anyway, because it's that kind of plan B, let the compounding take advantage of itself over the long term. So for most people, just in summary, a very simple wealth strategy is buy a good home. Don't be afraid of necessarily using debt to buy that home. And then contribute extra to superannuation for a long-term plan B for your retirement. Outside of that, I would say there are things that you can do to be more active if you're on the other end of the spectrum, which is you can start investing actively in the stock market. And that means buying index funds, buying ETFs, investing in real estate investment trusts, if you so please, or buying individual shares. Now, for me, I tend to do those things because I find them intellectually stimulating. So I'm a very curious person. I like to understand how businesses work. I like to understand human psychology. So that they all play a role in the stock market. So there's one final thing I'll conclude with, Pete, here, at risk of going on for too long, is there's this that ad that you see on TV for tortillas and tacos, and basically a little Mexican girl comes onto the screen and says, "Why not have both, the hard and the soft shell taco?" And the idea is that when it comes to money, most people tend to think it's one or the other. It's property versus shares. Like, there's a big debate. And at the end of the day, not only can you do both, you probably should do both. And so you can have the hard or the soft shell tacos. It doesn't really matter. And it doesn't really matter what anyone else thinks either. We tend to become very, parochial in the stock market. We think, oh, you like blue chip shares. Well, I like growth shares. So therefore you're wrong. And it doesn't matter. At the end of the day, it doesn't matter what anyone else does. It matters what works for you. And that's the journey that I've gone on. And that's what I've tried to instill on the people around me as well, is it's okay if you're different and you do something that works for you. Just try and buy assets and do it repeatedly. Find your own way.
Yeah, it's interesting. Yeah, so on the benefits or otherwise of property, I heard Kate Campbell on one of your podcasts talking about how she would find having a big mortgage just very, very stressful. But other people, they leverage up to the hilt, and that doesn't seem to worry them too much, at least in the short term. I guess the thing with real estate, it's very slow for a lot of people. It's to some extent boring, steady. And I tend to think of it as an investment for the kids. Because I've been doing it a long time, I'm quite happy to carry a few $1 million of mortgage debt, but like for other people, they wouldn't want to do that. So like the long-term focus could really be a pro or a con, depending on your personality type. I guess it's finding where you have a behavioral advantage and using that to your benefit. I heard Peter Thornhill say on a podcast that his portfolio in stocks went from 10 million to 7 million during COVID. But he just wasn't phased at all. So I've seen it all before. It's just a cycle. It'll come back, and it has. But like, you know, I can just say I would be crapping my pants if my portfolio went from 10 to 7 in a month. You know, it's about finding ways to make it work for you. So you talk a lot about the benefits of managing your own money. Obviously, no fees. So you've got the cost element. You've got the choice of where to put your money and control of your own destiny. So tell us a bit about some of the sort of best investors who can beat the market. You know, can you find fund managers who do it, or do they just fall by the wayside? And is the best way simply to learn to do it yourself?
Yeah, so I once had it impressed upon me that basically the only people that should invest in individual shares as opposed to a portfolio are people that have the time, they have the curiosity, and basically they have the inclination to invest. And so what I mean by that is if you're time poor and you don't really care about balance sheets and income statements and learning about investment strategy, it's okay. You don't have to be as active as, say, me, right? Like I like to do those things. The irony is for investment markets is the more that you do and the more that you pay in fees, typically the less you get. And I mean that with all sincerity. Like the studies back this up, that simple works. And, you know, Morgan Housel, who's the fantastic writer out of the United States, has this saying that 99% of long-term investing is doing nothing. It's the other 1% that changes your life. And I see that play out so many times in various guises. So whether you're investing in an index fund and you think, I'm going to switch index funds, if you do that, then you cause tax. That's that 1%, you know, taking away from your long-term wealth creation. Charlie Munger has this saying, compound interest is very powerful. Don't interrupt it. And there are so many great kind of like throwaway lines that I could bring up. But at the end of the day, I think how you invest is really down to your personality type and your temperament, as you say. So for me, you know, I like to invest in individual companies. And what I've found from the people that do it themselves, the private investors, what I find with them is there's no master that they have to answer to. So say we've seen all the studies out that show that active funds management, the professionals that we pay to pick individual shares or to buy different companies, as a whole, the majority of them tend to underperform. One of the big reasons for that, as you alluded to, was the fees that come with that. So if you think about a normal distribution, a bell curve, effectively what we do when we have high fees is we take that bell curve and we shift it to one side. So that by its very nature, by shifting that bell curve one way, we're expecting at least, you know, 60 or 70% of them to underperform because the average has moved down to one side. And so then beyond that, you've got to remember that the average holding period, so the average time a professional investor holds onto a share, and I can't remember where the study comes from, I've just got it in the top of my mind, is around 7.6 months. So a professional tends to hold onto an investment for 7.6 months. But as we've talked about, and as you talked about, Pete, long-term investing is exactly that. It's long-term. The benefits of compounding don't kick in after 7 months. They tend to kick in after 5 or 10 years. And so you want to find a way that allows you to do that. And private investors have the advantage of not having to produce a monthly report for their investors or for the shareholders or for whoever, you know, at the end of the month. So for private investors, there is a distinct advantage from having thick skin, like Peter Thornhill in this instance. Imagine if Peter Thornhill was investing other people's money and it was down 30%. He might even lose his job, right? He might be a fantastic investor and it might have nothing to do with his skill, but he might lose his job because of that. But as a private investor, he can keep holding on and he can keep getting dividends for many years to come. And so there are distinct advantages for being an individual investor where you pick your own ETFs, you pick your own index funds, and you keep costs low. But at the same time, that's not for everyone. Some people want to outsource to a financial advisor, and that's fantastic too, particularly if you have complex financial needs. For me, basically, I like to have the best of both worlds. So for me, I try and invest in diversified funds like index funds and what have you via ETFs typically. And then I'm also willing to scratch that curiosity of, I like this business. I've done some research into this business and I think it's got a bright future. I might buy some shares. And this is what we call, in simple terms, is a core and a satellite approach, where we have the core amount of our money, our bigger pool of money, invested in low-cost diversified portfolios. And then off to the side, we have a share portfolio, which allows me to kind of scratch that itch, to try my hand. And what I found is I'm just trying to replicate what other people have figured out before me. I think if you think of, like, there's a saying that the man without a master has a fool for a master. And forget the pronouns. It's really just that if you don't have someone who is helping you learn from other people as well as your own trials and tribulations, you're not going to figure out nearly as much or nearly as quickly as you could if someone else was helping you along the way. So I'm just trying to read books, bring some of those strategies into my own philosophy and go from there, basically.
Yeah, that makes so much sense. Yeah, because my background was as an auditor, accounting standards. I was auditing annual reports, and then later I was writing annual reports for listed companies. So I was all about analysis and value investing. But I guess, one of the lessons I learned is that you really have to do the analysis and not kid yourself that you're doing analysis instead of, because quite often you find I certainly found myself, you buy an investment because you like it, and then you do the analysis later to justify the decision that's already been made, kind of a hindsight or confirmation bias. And I guess there is this thing of the capitalist distribution, and depending on which study you read, you can say a handful of the companies make the bulk of the returns. What is it? 5% make most of the returns or something. And I guess this goes back to the old 80-20 rule. And I guess, look, for me these days, I'm pretty happy with ETFs, but that's partly because I've got more to lose. When I was younger, no kids and only a smaller investment balance. But these days, I don't enjoy the volatility. Now, you're a professional investor, so you probably love the volatility.
Yep.
And this is where I guess it comes down to finding the approach that works for you. I guess I have one other question, and that's what's the end game for you? You're obviously accumulating assets, but do you have a sense of how much is enough, or there's not so much anxiety about that? Are you just looking to enjoy it and follow the process and just build a solid enough financial base that you can then just enjoy the passage of time?
Yeah, I think that's it, Pete. Like, we talked about turning a vacation or vocation into one or the other. The idea for me is not necessarily, I don't have a lump sum in mind. So I don't have 5 million, 2 million, 1 million. Like, I don't have a number. I think partly because my wife and I, we have a startup, basically. That's the way we continue to think about it, even though it might make money now. We continue to think about it as if it's always, at risk. And so for us, we have this high risk tolerance, and we just want to make sure that we are doing things that we enjoy doing and we are happy. I think a lot of people, from my experience, a lot of people fall foul into the idea of, I need this a certain amount of money and then I'll be happy. But what we've discovered is it's actually the journey, not necessarily the destination. And for us, we have a small business and we can invest some money every month. We have a home which we still need to do up. It's still in need of repairs and renovations. But that's probably enough for us. If you look, this is activity. You mentioned Kate Campbell, who's my co-host on the Australian Finance podcast. She references this study from Ramit Sethi, who says that you should get a piece of paper in front of you, and down one side of the piece of paper, write the 10 things that make you happiest in life. There might be, say, going on a run. It might be your kids, or it might be spending time on a beach or something like that. And on the other side of the piece of paper, write down the 10 things that you spend money on, and do it in order of what you spend the most money on, and draw a line between those two columns. So if you spend most money on your mortgage, but you don't get any satisfaction of having your own home, then there's a mismatch in what's making you happy and where your money goes. And for us, we've kind of worked towards this, and we've kind of hacked our way to it, to be frank, where we've kind of got everything that we need. we don't need a bigger house. We don't need a fancy car. In fact, I spend more on an Apple iPhone every year than the value of our car. And we're content with that. We're happy with that. And so for us, everything from here on out is basically just accumulating wealth, accumulating assets that will hopefully one day pay us more in the future and be worth more in the future. And we're quite content with that, rather than tracking our finances every month. Like we used to do a budget. We used to have every expense that we'd have every month, how much we were saving, how much we were investing, a short, medium, long-term goals. And now it's more so, let's just save what we can and let's enjoy the journey. And hopefully from that, if we invest well enough over the long term, the rest will take care of itself. I know that's not kind of the answer that you're looking for, but there's some fantastic fire bloggers out there and people that are really transparent with their goals and how they plan to invest and save. Like the Aussie Firebug, Matt from Aussie Firebug. We've got Dividends Down Under. So many fantastic websites to track the journeys of others. We don't have any goals like that. It's more so just let's enjoy what we've got now and let's make sure we have enough to provide for the lifestyle that we want.
Yeah, I guess that's it, isn't it? For a lot of people, it's quitting the corporate job. But, what is happiness in the end? It's really just enjoying the passage of time. And I think it's quite clear from no end of studies that there's no specific amount of money that makes people happy. You can see that so many celebrities, they make more and more, but it doesn't make them happier. So if you're not enjoying life, you got to look at why and change it. I honestly could talk all day to you about finance. I'd sometimes say that's off the cuff, but it is actually true in your case. And I'll have to get back to you on the relocation to Noosa. I guess one of the issues we've got in the property sector, real estate, there's always been these perverse incentives and sort of off-the-plan sales and agency risk. And I think it was Charlie Munger who said, tell me where I'm going to die and I won't go there. Look, there's a lot of conflicted advice in real estate. Rask has become known as a kind of a fearless and high-quality independent education portal, I guess, is one of the things you're known for. Have you got any plans to do a property course for people, or have you done one already? Because I guess a lot of people must be weighing up that decision. Should they buy a home or should they do stocks or super? Is that something that's on the radar?
Yeah, so we do have a property basics course. I know you've got a wealth of resources, like incredible amounts of blogs and podcasts and what have you, that I would probably push people to first. But yeah, we do have a course on property buying, and it's mainly just for first home buyers, how you can save money, how you can think about the absolute basics. I would love to extend that. So I would love to have the next step for people. The reason that we brought in a property course actually is more out of necessity, because the property buying process, as you know, Pete, like better than anyone, is a very, very daunting process. And there are conflicted incentives right across the industry, whether it's the financial planner you see clipping the ticket on something that they recommend, whether it's, the mortgage broker who is like, that the barber when you ask the barber, should I get a haircut today? And they say yes. There aren't that many people that go into this and think everyone is on my side. And I found that to be the case too. So, and this is the same as on the stock side. I'm not beating up on property, by the way. Like, it's probably worse on the stock side of things. So I would say that, it's important to find resources that you trust and you understand the incentives of everyone. That quote from Charlie Munger is brilliant, I think, because if you knew where you were going to die, you wouldn't go there. But yes, in summary, Pete, we do have a property course, but most people come to us for things like getting started investing, for things like budgeting, for our calculators and those types of things. We're trying to bring a whole suite of it together, and we're just about to launch 6 new courses that are totally free. So hopefully there's more students that appeals to, and maybe, who knows, one day, this is a bit of a leading point here, but maybe one day we can do one together, because that would be heaps of fun.
Superb, yes. And working on you relocating to Southeast Queensland after your recent stay up in Noosa. So, Owen, it's been an absolute pleasure. If people want to find out more about Rask, where should they go for more?
Yeah, they can head to www.rask, that's rask.com.au. That's probably the best place to go. We've got heaps of courses that you can access from there. And that's, we do news and we do education, so many things that we talk about, not just me, but a fantastic team behind the scenes. Like you mentioned, my co-host, Kate Campbell, just an absolute powerhouse in herself. So that's where you go, rask.com.au.
Fantastic. Highly recommended, of course. Owen, thanks so much and look forward to chatting again soon.
Yeah, Pete, it's an absolute privilege. Thanks for having me on.
Cheers.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.